Does it matter to you where you make your money in the market? Does it have to be from a stock? Does it have to be from an option? Does it have to be in a certain sector? Or does it matter to you just to make money in the market, day in, day out, day out, day in? I'm asked all the time, what the hell is a futures contract? A futures contract is really not much different. It trades not much different than anything else in the market, whether it be a share of stock or a options, piece of paper. It's a piece of paper. It's a financial derivative. It's a piece of paper that represents a block of money valued in the NASDAQ so much, valued in the S&P, valued in the NASDAQ. It may be a gold futures contract. And what you're able to do is you're able to buy and sell these pieces of paper representing many multiples. They are leveraged, many multiples of whatever the underlying is. So as an example, the futures contract on gold, the initial amount necessary is in the neighborhood of about $6,500, thereabouts. And then once you purchase the contract, you have a maintenance amount, which is some fraction of that. And if you trade it intraday, some brokerages will give you additional buying power. If not on the gold or commodity contracts, but on the financial contracts like the S&P, the NASDAQ. So, for instance, the NASDAQ, the initial margin on a futures contract for the NASDAQ is about $4,000, give or take. If you trade it intraday, some of the brokerages you'll only really require about a fourth of that, $1,000. Now, if you carry it overnight, you need at least the maintenance amount. Now, it's leveraged. It represents a value of the NASDAQ, many multiples of 4,000. So it is leveraged. And if you get the trade wrong, you could lose quite a bit of money. You could lose, if you don't come out, you could lose more than 4,000. You could lose 10,000, 20,000. You could lose a lot. But if you are a disciplined trader and you trade with discipline and with the help of machines, when you trade, you stand to make a lot on a relatively small amount of money. Take, for instance, the NQZ, and we had many members that were watching this on Friday. This program triggered and it was up $1,660, fired at $252 on Friday afternoon. So by the close, you were up over $1,600. If you were to count the initial margin at 4,000, it's almost 25-30% return. If you're looking at just getting it in and getting it off, and you're only using margin of about 1,200, it's almost 100% return, right? It's the discipline of getting them in and getting them out, and having a very disciplined approach to the market. The futures market are where the banks play, is where the big boys play. And it has a number of advantages. It's highly liquid, meaning you can get in and get out. It doesn't have the time decay feature that options has. And it's open just about all the time, much more. An options market, you have to deal with the gap up or the gap down in the morning, and stocks the same way. Futures contracts are open virtually 24/7. With the exception of part of Saturday and part of Sunday. Highly liquid. So if you can trade with precision, which is what we try to teach our private members to do, trading futures can be a great way to go. Be sure to check it out. It does carry risk. and you can lose money, and you can lose lots of money in leverage products. It's not a panacea. But for those that know what they're doing and understand the use of stops and multi-exits and are technical traders and are familiar with the TradeStation platform, it can be a great way to go. On a number of days last week, our 2-minute NQ was producing $5,000 and $6,000 a day in that high volatility. I'm Brad Don at StockMarketCaddy.com. Feel free to check us out. We don't make a recommendation to buy or sell anything or to use anyone's platform in particular or to recommend that you trade futures. It's just something that you might want to consider.